Hi, I'm Soren Godbersen, Chief Growth Officer at EquityMultiple. One of my favorite parts of the job is connecting with our investors and hearing their individual stories about how they approach real estate investing and why they like the EquityMultiple experience. Of course, I also enjoy learning about how we can make the investing experience better and more personalized for each of them. Recently, I connected with Dr. Subhasis Misra, a physician from Florida, and in our wide-ranging discussion, we covered why he became a doctor, why he likes real estate investing, some specific insights on his experience investing with EquityMultiple, and advice for younger physicians who are looking to establish a more robust investment portfolio. I hope you enjoy the discussion as much as I did. Dr. Misra, hello. How are you?
Hi, Soren. How are you?
I'm great, thanks. Good to be with you today.
Same here.
Thanks for taking the time to talk. I'm always, super excited to talk to our investors about their background and their experience. So starting there, can you just tell us a little bit about yourself?
Absolutely. I'm very fortunate to be a dad of two young daughters, and their security and long-term success is something that, of course, I think about a lot as a parent. And also very fortunate to have an extended family, some very close friends. So I think the social support and the structure is very important in anyone's life. And I'm also in a unique position and feel very blessed that as a cancer surgeon in my work area, I'm in a place to really be with people and guide people at some of their most vulnerable times in their life. And so I think my day-to-day activities sort of goes hand in hand. They mix and match together, and it's been a great experience.
Fantastic. And yeah, thank you for the work you do, particularly at a challenging time like this. So you spoke to it a little bit, but can you tell us a bit more about how you decided to become a doctor?
Sure. Originally I'm from India, and back home, the typical expectation is either you become a doctor or you become an engineer. And I happened to grow up in a family of doctors and engineers. Having said that, as a young child, and I was more interested of joining the army and defense forces and other things. But my mom was a big influence, and she wanted us to be, successful and in a way independent, irrespective of what's happening with the cycles of economic cycles of boom and bust. So she always, and her father was a physician, was a surgeon, and she has, growing up in a physician family, she knew the difficulties, but also she knew the benefits, not only personal that you can, get for yourself and your family, but also the benefits that you can extend to society as a physician. So she was very supportive and strongly encouraging from a very early age. And as a result, I think both, like my brother and I, we are two siblings. We both ended up being physicians.
So when you first, graduated from medical school and began practicing, and I presume earning a healthy salary, how did you start thinking about investing in asset allocation?
Sure. Soren, for people in the medical field, we have a long sort of runway before we start earning compared to my colleagues and friends who are engineers or in any other field other than medicine. Because, the training is very long. And to a point, after I've been here like 10 years in this country, my mom said, are you ever going to earn? Or are you only going to keep on studying and learning more? So you get a little stipend as a trainee. So after medical school, typically here, people will go do a residency, which is anywhere between 3 to 5 years, depending on your specialty. And the amount of money you make is very little there because you're considered as a trainee. It's long hours. It's 80 hours a week nowadays. Before, there's no restrictions on hours, so it's like working two full-time jobs at least, and you get basically paid peanuts. So most of the residents, what we call them as trainees or residents, they don't earn a high salary. If you look at it per hour, and they make less than environmental services or any other services that if you can think of, right? And then after that, if you decide to do additional training like I did, that's another 2 years, sometimes it's 3 years or 1 year. So we have a long runway. And after several years of training, physicians typically, start earning a healthy salary. And I think that's where it's very important to for them to understand how to balance. You're so used to being living in a drought, and all of a sudden it's a relative flood. It's not a whole lot of money compared to the previous days, right? Back in the olden days where they used to earn even more. But the differential is such that people sometimes don't know what to do with that money. So, I'm also a program director of surgery residents, where I train future surgeons. And one of the things I talk to them routinely is about financial advice of how to manage your life, how to manage your finances. We barely have time to think about our medicine. There's so much learning to be done. So typically, doctors are not good at finances because there's not enough time in the day to learn about finances while you're learning to be a good surgeon or a good internist, whatever you want to do. So as a result, that part is a little weak. And then when they do get that healthy salary upfront, then they all of a sudden don't know what to do. And I think then lifestyle creep happens, and very sudden they see themselves in a lot of debt. Most students here already have a lot of medical education debt. Almost 200,000 is the national average to begin with. And you have all these excess work hours, but you're starting to earn at a sort of like a later stage in your life compared to your friends and peers who start earning way much more earlier. So the average physician starts earning in their, I would say, early to mid 30s. That's when the sort of the salary starts. But for a non-physician, it starts in their mid 20s, if not earlier, maybe around that time.
I've spoken with other doctors who invest with us too. You mentioned lifestyle creep. It seems like there's an awareness that there's a possibility of burnout mid-career for a lot of doctors, and that's why it's critical to establish passive income streams. Do you think about real estate investing or investing in other assets in that context?
Absolutely. Reflecting back on my journey, financial journey, if you will. So, like around 10 or 11 years ago, I finally finished my 7 years of surgical training here, right? And even during that time, even though we barely earned much, right, as a trainee, the advice was see whatever you can, if you can have any savings, try to put it in a 401k and let your employer match it, because whatever matching you get, that's basically extra money that you earn, that you don't have to worry about it. So even if your portfolio takes a little hit, as long as your entire principal is not wiped out because of the match, you still end up with some money left. So as a resident, of course, I put whatever money I could save, and I was fortunate that my hospital matched it, and that went on for some time. And of course, there's the power of compounding. At that time, there's most of these 401ks, they don't have the concept of real estate directly. Platforms, they have REITs. You can invest in an ETF that has a REIT. So you do some, and those, I think at those early stages, most of the people back in the days, we used to just invest in some mutual funds because that's what the financial advisor advised. Now I know ETFs are much better from a tax perspective, and from a sort of like a liquidity perspective. And with time, as we started talking to people and you talk to your mentors, they will say, oh yeah, the real estate is doing well, or oil is doing well, or you should always have some money here. So that's how we started building sort of our portfolio, if you will. And as physicians, we are used to educating and learning. So I think it comes natural to us that once we put our mind to something, we will learn it. And so I started doing a lot of sort of like self-help, do it yourself, and I'll go to morningstar.com, started learning the basics. And I also was fortunate that I did my master's in health systems management. So that gave me a good sort of background. What is accounting principles, those kind of things. Those are a little different than the stock market, but at least I learned some basic financial concepts. For people who don't have that background, I think it's still okay. If you can self-educate yourself, you look at do it. There's a lot of nowadays. It's a lot of websites dealing with financial stuff, and they will guide you. And as I was going through, say, Morningstar, I started learning the various buckets. Then you read an article on real estate planning, right? Or you read an article on various kinds of investments. So what's an ideal portfolio? So all those things, are you aggressive? Are you moderate? So I dipped my feet in the financial world with the stocks mainly. Like, and then so from, mutual funds, some individual stocks, and then I gradually moved to ETF. And then as I was continuing to educate myself, I realized that real estate is a in the long run is highly beneficial. Yes, we have plenty of real estate in India. Real estate is heavy in demand. You can imagine, in India we have 4 times the population than the country United States, right? And one third the size of the country. So real estate is always in heavy demand. So growing up, I knew the benefits of real estate. Here it was, here you can always expand more to the suburbs, and then your boom may not be as much. But I still think there's a lot of benefits, and I'm gradually, every year I see the benefits of real estate more and more. And I think it suits us as a profession. If you're a professional that has a busy day job and that you cannot be a day trader and that you're not sitting by a computer all day long, I think real estate has even more advantages because it gives you peace of mind. It will have steady flow returns. Every now and then there's a little hiccup, but I think the hassles are so less, especially if you have a good partner, say like Equity Multiple. I consider myself, any place that I invest with, I consider them as my partner, be it Vanguard, be it Fidelity, be it Equity Multiple. So if I trust my partner and that I know they're doing their due diligence, they're protecting my money as if it is their money, then I don't worry about it because I see the returns that comes, the monthly steady stream of income that is coming. It may not be as great as like a crypto market that I'll shoot up 100% overnight. And you know what? It has its own place, but I think real estate for a busy professional like ours, or for any profession that cannot be in front of a computer during market hours, I think real estate is the way to go.
Right. Certainly, the real estate asset class behaves a little differently from cryptos, from what we've seen so far, at least. So you alluded to it a little bit. Can I ask you about the experience of investing with Equity Multiple? I guess how did you come to us to begin with, and what do you like about investing in the platform?
Sure. I think, as I was reading through all these various, online self-help, self-education, real estate, I still have a lot of, I have an account in Vanguard. We started very early. I've enjoyed their low fees. And then, and on the professional social media, I think that's where I came across LinkedIn. I think on LinkedIn I came across Equity Multiple, and I was like, oh, let me check this platform out. And I think it's curiosity drives learning kind of concept, adult learning concepts, and but also by that time when I was looking at Equity Multiple, I had invested in a couple of other online trading platforms. I mean, real estate platforms with sort of mixed, experiences, if you will. Some good, some not so good. And my advice to anyone starting out is always, and I say this to my friends and colleagues as well. I said, if you're not familiar with an entity and you have to check them out. That's the only way you will know. You read the reviews, but if it's a new entity and you do some due diligence in that, you have to sometimes test the waters and see how they do. So it's always nice to start small, look at their website, see, are they very open about their success and their failures, what have they, because most people will only put what are the good things they have done, but not like or how it is going on. So, and always start small till you get more familiar with this, with the interface, with the company, get a couple of small, successes, and once you get more comfortable, then you start making your bigger bets, bigger investments. And everyone has a different risk tolerance. Typically, I consider myself to be an aggressive investor in the stock market. My graph is more oriented toward aggressive partly because I had the time frame to work up towards to ride over the market cycles. Never been a big fan of bond markets, but real estate to me is, again, it balances my portfolio very well while giving me very robust returns. So with equity multiple, once I found out, I think I remember making some early investments. And one great thing about equity multiple is the routine that you expect. If you guys have said, it will be a monthly distribution, it happens to be a monthly distribution. It's a quarterly distribution. There's always a quarterly distribution. I would say, I'm just making it up, 90% of the time that has been successful with equity multiple. And over a period of time, I started small. Based on my initial success, I started investing more and more. And lo and behold, all of a sudden, I found myself in the bracket that you guys know, in a high bracket of investment with you all. And I would still say I think equity multiple has, in my mind, more than a 90% success rate in the monthly distributions. Now, every now and then, there are certain projects that might be a little delayed, but I think that's where the communication piece comes in. And I think your associates, your team as a whole, they have done a wonderful job. They'll say, okay, this is what we're working on. Here's a problem, and every month there's some communication as to what's happening. So even so, like it will say payment unavailable. While that is not something that me as an investor want to see that, but at least I know there are people at work trying to fix that problem, trying to get it out of the weeds, if you will. One example I can think of was I think there's a Nevada thing that was on the sort of the cannabis industry, the Nevada real estate. So I had invested a significant amount there, and initially they made some distributions, and I think then COVID happened, this and that, and then there's some delay in that, and eventually I was like, oh, what's going to happen? But behind the scenes, that came as a very pleasant surprise. Behind the scenes, you guys are working, which we had not aware, like all the details, and you managed to come out, sell out that property, and we managed to actually make a profit out of it. So I think that to me was said a lot and meant a lot as an individual retail investors, saying that here's a company that could have said, it's not working, just let it go. They pursued, and they were able to recover my principal, and I got something extra. So I may not have got the full extent of that benefit, but at least I saved my principal. That gave me a lot more confidence. I think that was last year or something that happened, and as a result, I could then go out and tell my colleagues and refer them to Equity Multiple, saying, "Hey, why don't you check this out?" And there's a lot of crowdfunding platforms and sourcing platforms, as you all know. And but I think what helps most is the word of mouth referral, right? People will see, we all as professionals, we see a lot of things on LinkedIn, but I don't go and put my money everywhere. I have been with you guys for 3 to 4 years now. And when I tell my friend, they trust me. So I'm not going to tell them about any company that I invest till I have sort of internally, I'm satisfied that I've vetted them, that I'm comfortable with them, because it's my reputation too. And so that's how I could go out and ask a lot of my friends to check equity multiple out, because I also want them to be, have a good sort of steady income, passive income, that they know that somebody behind is working out for them, and looking out for their best deals.
Sure, sure. Appreciate the kind words. Um, and yes, communication is critical for us because, as you mentioned, not every real estate investment is a home run, but if there are hiccups, it's certainly better to keep investors informed, even if the details are less than optimal. So you mentioned equity multiple being a good complement to other assets in your portfolio or to your asset allocation strategy in general. And I believe you've participated in dozens of investments on equity multiple at this point. Is there a particular type of investment, a particular structure, a particular risk return profile that you gravitate to at this point, or is it sort of all over the map?
The I think I look at, of course, the return, the loan to cost ratio, I read. I really found it very helpful. All the details that is provided by your team. Like the projected financials. I do look at areas where bigger cities, better chance of the asset performing well. I was a little hesitant when I signed up for the Utah one, but lo and behold, that turned out to be one of the better ones. So again, it's a learning process. Typically, I've always enjoyed like the luxury condos in be it in Manhattan, Boston, Chicago. Those have always performed very well. Again, bigger cities, there's always a heavy demand. I was very surprised, positively, surprised with Delray Beach condominiums. That turned out to be a great one. One of the recent surprises was the space investments, the car wash. I thought that won't be as great. I mean, it still is a great return, but I was like, oh, it'll take time. But it turned out completely. Again, that was a very pleasant surprise as to the return on investments from all the different car washes that Equity Multiple had signed up in the Florida, Georgia area. And of course, it helps that a lot of the entities are in the Suncoast belt or in areas where I have lived or I know the market well. So that gives me some confidence. One of the other areas is the with all the online things happening. So I think the industrials, I'm a big fan because most of the big companies are going online, so they need warehouses. I think that asset class seems to be very nice for me. I know the flavor currently is the single family market and those kind of things. So that is I still invest in that. Um, the hotels overall, I think I'm a little hesitant now. Partly it could be COVID, but I think a bunch of the hotels that I had invested, their returns have been not as robust as I would have preferred. So, but I think those are some of my sort of thought process after having invested more than 40 some entities within equity multiple. So I have a good flavor of what to expect and now what to do.
Right, right. And, I think you mentioned 5 or 6 different markets and 5 or 6 different property types there. And that's, I think, part of the fun of the process, real estate investing in general, but also the equity multiple experience is, you get to learn about all these different markets and submarkets and all these different strategies around different property types and business models. So, yeah, I think, over your 40 investments, you have exposure to quite a lot of different profiles of deal. Um, Great. So yeah, I think you spoke to this a little bit previously, but if you knowing what you know now, learning what you have learned over the course of your investing career, what advice would you have to a younger you or to a doctor, a few years out of residency and looking to establish those passive income streams?
Right. So, as I mentioned briefly, I train other doctors like to be future surgeons. So we discuss a lot about these, and we talk about lifestyle creep because people all of a sudden, they're used to getting 45,000 a year, 50,000 a year, right? I know I'm being a little granular. Working 80 hours a week, they will only earn that much. So even if for a specialty, say they earn 180,000 when they graduate, that's like fourfold their income. So all of a sudden they feel rich, right? They're not really rich because they don't understand all the financial world very well. Again, all they know is medicine from an early age. So they're not taught on that. And so they will buy a house or a fancy house. Then they don't realize, of course, I have to pay mortgage, I have to pay interest, I have to do this. Yes, the sum of amount that the overall salary looks big, but then the moment you become a higher earner, 40% goes in taxes or 30 some percent goes in taxes, right? And then you have all these mortgages and fees, and then so all of it, and you have your student loans. So it may seem you're earning much, but your day-to-day expenses are not as great. So we always advise them, start slow, start investing as well. You just don't want to, I mean, you enjoy life, no one is saying don't enjoy life, but don't get that fancy boat or the car or a fancy house and then you are stuck, because most of the time, as we also know, and we teach them that the first job, there's no guarantee that you're going to stay there for the rest of your life. So you go to a job, you go to a new city, and you buy a fancy house, then 2 years later, for whatever reason, the job doesn't work out for you. Now you have two mortgages that you have to deal with, right? You have the pressure of the job itself. Medical malpractice is a real thing. So for people who are in that field, they understand the pressures from dealing with medical malpractice. So on top of that, why take that unnecessary financial headache of trying to maintain two entities, two mortgages? Then you have, then you marry, then you have a child, and as we all know, so there's an expense that keeps on growing till you sort of establish yourself after a few years. So
Right,
we
having a kid or
advise.
two is a huge expense line item.
Right. So most physicians, when they graduate, they don't really understand all that because they're just at the beginning of their life and career. So we tell them to sort of take it slow and easy. I also tell them invest. Even though you're a resident, you may not be earning as much. Start investing. Get the benefit of the company match. Most companies will do the vesting portion. So when you graduate, if you have 100% vested after 5 years of training in surgery, for example, that's extra money that otherwise would have left on the table. So we always encourage them to start early. And initially we tell them just go with the ETFs or whatever the funds, because those are limited, based on where you work. They will offer either Fidelity, TRF, or Vanguard, whatever it is, right? And so by that time they graduate, they're understanding how finances work a little bit and what to do. And once they graduate, I tell them real estate is something that you will rarely go wrong with. It's not going to be as quick of a money overnight, but the money that you get in real estate, as you start earning your income, the real estate, the structure is such, you benefit from depreciation, you get your monthly income as well. And in the event of a liquidity event happening 5 years from now, you get a bunch of money back, hopefully at some big multiple of it of what you have invested. So you have money that comes on as on a sort of a monthly basis, on a daily basis, that you accrue. You can write off a lot of money from and taxes because of depreciation, and your long-term potential is great. So those are all long-term capital gains, and then you are paying less than your original based on your salary and W-2s, because nowadays majority of the physicians are employed. So very few are going out in pure private practice where you're running your own business. So that entity itself is very different. So as a W-2 holder, you don't get that benefit of saving a lot on your taxes. um, so I think that's how real estate, one, helps a lot of those. Two, as I was mentioning earlier, if you're not like a day trader, if you're not hanging around on Wall Street, I think it's best, rather than investing in individual stocks, put your stuff in a sector. If you think a sector is going to do well, put it in an ETF, and let it ride out, and you don't have to worry about the day to day. And the same, I believe, is real estate. And no matter what happens in the stock market, this is an independent thing. Of course, COVID happens. There's some issues with rent and some issues with growth of the projects and all. But overall, they balance out. And despite COVID, we have seen real estate has been very steady and continues to increase and grow. So I think it's a great asset, and that I will encourage any young physician to start early. Now, one thing I would tell them is, as busy individuals, it's very hard to own personally, an apartment, because you need that upfront money to buy it. Most physicians early in their career, one, you don't have it, right? Two, how are you going to maintain? Then you have to hire somebody to maintain that. That's an extra hassle. When you're trying to set up your own practice, your focus is on that and not on running a real estate business, or getting a rental today, something broke. So I have found that yes, that might make you a little bit extra money maybe, but that hassle is not worth it. To me, I would rather do like partner with an online crowdsourcing platform, online real estate platform. There are many, you pick and choose. I happen to be comfortable with real estate, so I have reduced, I mean, with equity multiple, so I have reduced my allocations with other entities that I had. I'm not making any new ones because I was like, well, my experience was not great with them. I still have some money invested that I know will be stuck for several years, depending on, so that's why my horizon is typically 3 to 5. Beyond that, I don't tend to invest as much because who knows what's going to happen, right? And we all think we are immortal, but we all know that that's not the case. And especially in the medicine world, where and as a cancer surgeon, we see life at its raw form. We see how life can be so unpredictable, right? You may be 40-year old, all of a sudden you're diagnosed with cancer, and then life just changes upside down. So my horizon in real estate is typically 3 to 5 years. Anything more than that, I'm a little hesitant to invest, because also I don't know how my family is going to manage. I have young people in my family; they may not be in a position to handle all those things, right? So, and I think that's why long term, I'm thinking of your investment portfolio. Then you plan your estate planning, those kind of things. So we talk about all those things because I think it's very important to get an overview of what finances entails. And so for professionals, I always encourage going out to a platform, say like Equity Multiple. I said, let them do the heavy load, let them work their do their due diligence, go through every little nook and corner. So if they're vetting something, they're putting something in their website, they have done their due diligence and they have dedicated people who follow up on that. We won't have that kind of time.
Right. You don't want a tenant calling you with an overflowing toilet when you're preparing to go into surgery.
Exactly. So that's why I've never been a big fan of owning apartments myself, because it's just too much of a hassle. It's not that it's not just worth it.
Right. Right.
I think it's a great field if you can do it well, but I think you need the resources to do it well.
Sure. And when you're trying to establish yourself as a physician, you don't have time for that. You don't have time to be a day trader either, most likely. So
Right.
yeah, it makes sense. Well, Dr. Misra, this has been educational for myself, certainly, and I think for anyone getting started in the real estate investing space. So I really appreciate your time, and look forward to speaking with you soon.
Yep, anytime, and thank you for all the wonderful deals that you guys get. One of the things I also reflect is, uh, more the deals is not necessarily better, because sometimes many organizations will just put out a bunch of deals, and then your money gets stuck for 2 3 years. I would rather that I may have less number of deals, but I know, like when I look at various platforms, sometimes if there's not a deal, that's okay. But if there is, that means people have done their due diligence. That's a safe bet. Let me go for it. So thank you for doing your due diligence all the time.
We'll keep doing it.
Okay, great.
All right. Thank you,
Thank
Dr.
you.
Misra.
Talk to you soon. Bye bye.